Hi friends, in this video we'll learn about the straight line method and we'll learn the straight line method through a simple illustration. Now, what is straight line method? In straight line method, the amount of depreciation remains the same over the useful life of the asset. That means the depreciation which we charge to the P&L account or the depreciation which we charge on the asset remains constant or remains the same. It's also called as a fixed installment method. Fixed installment means the depreciation installment every year remains the same. So if you draw a graph with the amount of depreciation for various years, what will happen is if you prepare a small graph where on the y-axis you have depreciation and on the x-axis you have the life, 1 year, 2 years, 3 years, 4 years, 5 years, etc. You will find that the depreciation amount will remain the same, and if you draw a graph, the depreciation amount every year will remain the same. That is why this is called as the straight line method or the fixed installment method. Now let us see an example and then we'll go deep into it. An asset is purchased at a cost of rupees 1 lakh with an estimated life of 4 years. So the business is purchasing an asset at a cost of rupees 11 lakh, let us say on 1st April 2021. An asset is purchased at a cost of rupees 11 lakh on 1st April 21 with an estimated life of 4 years. So the manufacturer of the asset or the seller of the asset has told you that the asset has a life of 4 years and expected scrap value of 1 lakh at the end of useful life. Generally, who will estimate this life of the asset? Either the seller of the asset will tell you what can be the useful life of this asset, or based on experience, if you have been using such type of assets earlier, your earlier experience with the assets will also tell you for how many years you will be able to use the asset. So if you are using a car in the past, you know for how many years you can use a car. If you have been using a computer in the past, you know for how many years generally you'll be able to use the computer. So the life is estimated by the manufacturer, by the businesses based on their previous experiences. An expected scrap value of rupees 1 lakh. Again, based on the experience with similar assets in the past, you would be able to estimate what is the scrap value you are going to get when you sell the asset at the end of its useful life. So let us say after 4 years, the asset becomes useless for us. Instead of occupying space in our office or in our factory, what we'll do is we'll just try to sell it away to a scrap dealer so that we get some scrap value out of it. So at the end of its useful life, we are estimating that we are going to get 1 lakh. So logically, what is going to happen? Today I am purchasing the asset at 11 lakh rupees cost, and after 4 years I am going to get 1 lakh rupees out of this asset. That is, when I sell away the asset, I am going to get 1 lakh rupees. This is my cost, this is my scrap value. So I have spent 11 lakhs today, and after 4 years I am going to recover only 1 lakh. That means I am going to lose 10 lakhs over the 4 years period. We call it as depreciable value. So the original cost is 11 lakh, estimated scrap value is 1 lakh. The difference, 10 lakh, is the loss that can happen to the business, and that amount is called as depreciable value. This 10 lakh has to be spread over the life of the asset: first year, second year, third year, and fourth year. So how do you spread this loss over this 4 years period when you have used the asset? The logic is very simple. If you have used the asset in the same manner in all these 4 years, the depreciation charge cannot be different in these 4 years. Simple concept. If you have used the asset, the way we have used the asset, if it does not change in these 4 years, then there should not be any change in the amount of depreciation also which is charged for these 4 years. So if you assume that we have been using the asset in the same way in all these years, the depreciation would have to be charged equally over this 4 years period. So we'll charge 2,50,000 rupees every year. How did I arrive at this 2.5 lakh? I said depreciable value divided by estimated life. That was 4 years. So ultimately I end up using a formula for calculating the amount of depreciation. The formula is depreciation amount for an year. How do you estimate it? It is original cost minus estimated scrap value divided by estimated life. So what is OC? It is original cost of the asset, the cost which we have incurred to buy the asset. ESV is estimated scrap value. And EL is estimated life of the asset. So this is the formula we use to arrive at the amount of depreciation. So in this problem, if you apply the formula, original cost was 11 lakh, estimated scrap value was 1 lakh, divided by estimated life was 4 years. So it comes to 2,50,000 rupees per year. Now let us prepare the asset account and also the depreciation account for this asset account, depreciation account. 1st April 21, to bank. We have purchased the asset. We pass the entry asset account at our to bank. So asset account is debited with to bank. At the end of the year, we have to charge depreciation. 31st March 22, we pass the entry by depreciation. In our earlier video, we have seen that the entry for depreciation is depreciation account at R to asset. Depreciation account will be debited and asset account will be credited. So on 31st March 22, I'll write here to asset in the depreciation account 2,50,000. Now what will happen to the asset? On 31st March 22, I do balancing, carried down 8,50,000. 1st April 22, brought down 8,50,000. What will happen to depreciation? It will be transferred to P&L account. P&L account at our depreciation is the entry we pass. The depreciation account will be closed. There will be no closing balance for depreciation. So in the asset there is a balance of 8,50,000. Now at the end of second year, we are again going to pass entry for depreciation. Depreciation account at R to asset is the entry. In the asset we'll write by depreciation 2,50,000. In the depreciation account, I'll pass the entry to asset. Depreciation account at R to asset is the entry 2,50,000. 31st March 23, there will be some balance left, carried down 6 lakhs. 1st April 23, brought down 6 lakhs. Here the balance in depreciation account will be transferred to P&L account. I'll transfer the amount to the P&L account by P&L account on 31st March 22 and 31st March 23. We'll transfer the amount to P&L account and close the account. Now come back to the asset account. 1st April 23 year starts, 31st March 24 year will end. What is the entry we pass for depreciation? Depreciation account R to asset. So we'll write here by depreciation. Again 2,50,000. The amount of depreciation will not change. 31st March 24 to asset 2,50,000. We'll do balancing at the end of the year. We'll be left with a balance of 3,50,000. First April 24 brought down 3,50,000. Here the amount of depreciation will be transferred to P&L account 31st March 24 by P&L account 2,50,000. Now on 1st April 24 the year will end on 31st March 25. Depreciation entries depreciation account are to asset by depreciation 2,50,000. Now there will be balance of 1 lakh left here. What we'll do with that balance I'll tell you. On 31st March 25 we'll write to asset 2,50,000. This will be transferred to the P&L account 31st March 25 by P&L account 2,50,000. Depreciation account will close. Now you are left with 3,50,000 minus 2,50,000. Now you sell away the asset. Let us say you are not able to sell the asset exactly for 1 lakh rupees. Now, for this example, I'll try to be very simple. Let us say we are able to sell the asset for 1 lakh rupees. So what is the entry you'll pass? Bank account that are to asset account. We have sold the asset and we have now got only 1 lakh rupees. So I'll pass here 31st March 25 by bank 1 lakh. At the end of the year I have sold the asset. Now the account will close because we have sold the asset exactly for the estimated scrap value 3,50,000 minus 2,50,000. Only scrap value was left here. We have sold the asset for exactly its scrap value. So there is no profit or loss on sale of the asset, and we have been able to charge depreciation equally. Now using the above problem, if you try to draw a graph, this is depreciation and this is life. 31st March 22, 31st March 23, 31st March 24 and 31st March 25. So 2,50,000 was the amount of depreciation. This year also same amount. 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 If you draw a line through all these points, then you have the SLM method. The depreciation remains horizontal, or the depreciation curve is a horizontal curve. So it is a straight line. That is why this is called as a straight line method of depreciation. So what is the formula for calculating depreciation in the straight line method? Original cost minus estimated scrap value divided by estimated useful life of the asset. Thank you.